Welcome to The Explainer. Today, we're going to cut through all that financial noise and build a real, actionable roadmap for your very first portfolio. And our focus? Well, it's on one of the simplest, but honestly one of the most powerful tools out there for building a low-risk strategy, the humble trend line. Man, that quote really hits home, doesn't it? For so many of us, finance feels like this force that just happens to us, a push here, a shove there. But what if you could actually learn the lessons the market is trying to teach you? Today is all about that, learning how to stop being pushed around and start navigating with real intention. So here's our game plan for this explainer. We're going to start with the most important piece of the puzzle, your mindset. Then, we'll get you set up with the right tools, teach you a framework for making decisions, and then really dive deep into reading charts in the simplest way possible. And from there, we'll build a repeatable, low-risk strategy before we send you off on your journey. Okay, before you invest a single dollar, before you even look at a single chart, the most important work has to happen right here, between your ears. Seriously, the biggest leap you can possibly make as an investor is just shifting how you fundamentally think about money and your role in growing it.
Most of us are basically programmed from day one with the employee mindset. The path is super clear. Study hard, get a good job, work for pay raises, get better benefits, and hey, there's absolutely nothing wrong with that. But it's a linear path, right? You're trading your time for money. The investor mindset is about a totally different goal. It's not about earning more, it's about owning more. The focus completely shifts from the size of your paycheck to the size and, more importantly, the performance of your assets.
And this image right here, it just perfectly captures that end goal. Your job becomes planting and taking care of these financial trees. Those are your assets. Yeah, at first, they need your capital, they need your attention. You have to save money from your job to water them. But eventually, if you do it right, the roots grow deep, they start to generate their own growth, their own income, and they provide for you whether you're actively working that day or not. That is what true financial freedom looks like.
All right, so now that our mindset is recalibrated, it's time to assemble our toolkit. You wouldn't climb a mountain without the right gear, would you? So you definitely shouldn't step into the market without the right tools and, just as important, the right mental armor.
So what's the biggest thing that holds new investors back? It's the fear of pain, right? The fear of losing money, of making a dumb mistake, of failing. But look at this powerful little equation. Pain is going to happen. You will make mistakes. The key is what you do next. If you can pair that pain with some honest reflection, really analyze what went wrong, it transforms into progress. Every single mistake just becomes a tuition payment for your financial education.
So the crucial point is really how you frame your failures. Think about the Alamo. Militarily, it was a total disaster. But that's not how anyone remembers it. It's become a symbol of courage, a rallying cry. You need to do the exact same thing with your early trading losses. Don't see them as a reason to quit. See them as your Alamo, those foundational lessons in what not to do, stories of battles that ultimately made you a smarter and more resilient investor.
Okay, let's talk practical tools. Before you risk any of your real hard-earned money, you need two things. First, a paper trading account. Think of this as a simulator. It lets you practice making trades with fake money, but using real, live market data. It's basically a flight simulator for learning how to invest without any actual risk. Second, you need charting software. This is your map. It's how you're going to visualize the market's terrain and actually start to make sense of all its movements.
Okay, so you've got the mindset. And you've got the tools. But a map is pretty useless if you don't know how to read it, right? The market throws just an overwhelming amount of information at you, so what we need is a simple, reliable framework to filter out the signal from all that noise. And that is where the 4 pillars come in.
Now this framework is designed to be super scalable. It's simple enough for a beginner to get it right away, but it's also deep enough that professional investors spend their entire careers just trying to master each part. It breaks the massive world of investing down into 4 distinct, manageable areas of focus.
And here's why this is so effective. Each pillar answers one of the essential questions you have to ask before any investment. Fundamentals, that helps you identify a quality asset, the what. Technicals, which is what we're going to focus on today, that helps you with your timing, the when. Cash flow is all about the strategy you use to actually make money, the how. And finally, risk management is about protecting your capital so you can stay in the game, or how to stay safe.
All right, now let's zoom in on Pillar 2, technicals. We are going to strip this down to its most essential component for beginners, and we're going to do that by learning the simple art of reading a chart. And we'll focus on just one thing, trend lines. Seriously, for a moment, just forget all the complex, intimidating indicators and oscillators you might have heard of. The single most important skill in technical analysis is just learning to see the direction of the market. And you do that by simply connecting the dots. You look at the peaks and valleys on a chart, and you draw a line. It is truly that straightforward to get started.
So what are we looking for? First up, an uptrend. Just look at a chart and find the significant low points, the valleys. We call these swing lows. Now, as you can see, when you connect these lows with a line, it points up and to the right. Each new valley is higher than the one before it, and each new peak is higher than the last one. This is the classic textbook sign that buyers are in control.
And on the flip side, we have a downtrend. It's the mirror image. Here, we connect the significant peaks or the swing highs. And you can see they're getting progressively lower just like the valleys are. When a chart looks like this, the market is heading down and the sellers are in control. Identifying this is just as critical as spotting an uptrend.
So the takeaway here is really simple. As a new investor, your job is not to be a hero who perfectly predicts tops and bottoms. Nope. Your job is to identify the direction of the current and just swim with it. If the market is in a clear uptrend, you look for opportunities to buy. If it's in a downtrend, you know what? Your safest bet is probably to just stay on the sidelines. Don't fight the trend.
Okay, so now that we can identify the direction of the road, we need some rules for how to drive on it. Knowing the trend is a huge piece of the puzzle, but it's not enough. You have to pair that insight with a disciplined, predefined, low-risk plan before you ever put a single dollar on the line.
This right here, this is what separates professionals from gamblers. Every single trade has to be based on clear criteria, not on emotion. You have to write it down in a trading journal. Why are you getting into this trade? What specific thing on the chart tells you now is the time? And even more importantly, where will you get out? You need to define in advance the price where you'll take your profits and the price where you'll admit you were wrong and cut your losses. This plan has to exist before you place the trade.
Now here's the simple but profound math that can put the odds firmly in your favor. It's called asymmetrical risk-reward. As a beginner, you really shouldn't even consider a trade unless your potential profit is at least twice as large as your potential loss. So if your plan says you'll cut your loss if a stock falls by $1, your profit target needs to be at least $2 away. This one rule, it can be the entire difference between success and failure. And this chart just shows the incredible power of that simple rule. Imagine you make 10 trades and you're only right half the time, a 50% win rate. Well, if your 5 winning trades make you $100 each, that's a $500 gain. But because of your 2-to-1 rule, your 5 losing trades only cost you $50 each, for a total loss of $250. So even being right only half the time, you still walk away with a $250 net profit. This is how you build a sustainable strategy.
And finally, let's talk about risk management for your whole portfolio. See, true diversification isn't just about owning 10 different stocks. If all 10 of those are tech stocks, they're correlated. They're probably all going to sync together if there's a tech sell-off. What you need are non-correlated assets. Think of it like owning both a gold mining stock and a stock in a high-growth tech company. They often move in different directions, so a storm in one part of your portfolio won't sink the whole ship.
Wow. Okay, we have covered a tremendous amount of ground today, from the philosophy of being an investor all the way to the practical nuts and bolts of placing a low-risk trade. But you got to remember, this isn't a finish line. This is the starting line of your journey as an educated, disciplined investor. You know, the goal of this explainer was never to give you some magic formula. It was to equip you with a new way of thinking and a process that you can follow and build upon. We've gone from mindset all the way to a full-fledged strategy. The knowledge is now yours. So the only question that remains is the one right there on your screen. What's your first step going to be? Thanks for watching.